Now let's get started. Welcome to the Passive Investing Made Simple Master Class. Now, this webinar is going to be a little bit different since our fearless leader Whitney is out. I'm going to be stepping in, and so this one is going to be a lot more interactive, I would say, than previous ones. Not to say that Whitney's was not interactive, but this one it was really to act like we were having a virtual investor coffee. And so we do have 10 questions that we're going to go through. I actually have more than 10 questions just as a little bonuses, just because I think there are so many questions out there that it's vital to ask, right? I don't think there's a limit of questions that you should ask. And even when you do come into the framework of asking these 10 questions, just because you like every single, just because let's say these questions are sort of just answered, doesn't necessarily mean it's like a checklist and you should be investing with that operator like right away. There's meaning behind some of these questions, and there is really just about building the relationship and more conversation topics to dive into, to learn more about the operator, learning more about the investment strategy, and learning more about the asset class. So as I'm going through these questions, make sure you find that Q&A box over in Zoom, and then we'll just have a free-flowing conversation. I can read over the questions, and then we can talk about what some responses will be. It will be good, so what response will be bad, etc. All righty. So first question, one of the top questions, is discussing the group's operation background. So what is the group's operation background, and how many syndications have they done? Now, this is really vital when you are talking about the operator, because at the end of the day, the operator is really the one that's going to be driving the business plan. No matter what the financials look like, you actually have to have somebody that knows how to manage a business, because essentially what we're doing is we're buying businesses and making sure that they're operating well. We're maximizing revenues, and then also decreasing all of our operational inefficiencies. So making sure that they have that background in business that they can take into. And of course, it would be great and a huge plus if they have that background in syndications and actually managing a multifamily asset, storage asset, car washes, etc. And something else to also keep in mind too, when you are taking a look at the managing partners, is taking a look at what roles each of these managing partners have. When you take a look at the managing partners, you don't want one managing part, or let's say two managing partners, having very similar roles, just because you'd want them to spread out and just know their entire skill set. And so I'll just use for our team, passiveinvesting.com, we had Brandon, Danny, and Brandon. Dan. I think I said Dandon. I don't know if I did or not. Dan Handford, Danny Randazzo, and Brandon Abbott. And so within those three, they had three very distinct skill sets. So Dan came from the background of owning and operating his businesses. And so he had this experience of scaling businesses from his first chiropractor practice to 4 chiropractor practices, and then combines that skill set into also his experience as a passive investor. Danny Randazzo comes from a financial consultant's background, where he was a financial consultant for Deloitte, and he was traveling the world advising companies on their profits and operations, whereas Brandon Abbott had this background in acquisitions and really just building those broker relationships and really just having that on-site skill set, just to be able to assess risks and really just get a strong idea of what's going on at the property. And so having those three skill sets is also, they're all complementary. And so just a long-winded way of saying, just looking for complementary skill sets for the groups that you're looking to invest in. And then also too, if they do have it, making sure that they have a track record, which then also leads me to the next question that I would ask is, has there ever been a capital call? And then if there's ever been any failures or challenges that have come up through their time being together. And this one, what you're looking for when when you ask this question is, how are they going to respond? Are they going to try and sheathe the covers, or are they going to be humble about some of their mistakes and then talking about how they're assessing the mistakes and then moving forward? Especially within these syndications, transparency is key. And if they can own up to some of their challenges that they've had and then talk about what they're doing in order to mitigate it, I think that's a huge plus and also a huge test of character. Because I mean, at the end of the day, you're investing in the who, like I've always said, but you really want to make sure that you can trust these people to know what they're doing and be able to hedge on any obstacles that are going to be coming around. And so I would look for a particular story, and then even talking about some of those current assets, the current assets that they've had, some of the ones that they've gone full cycle, and some of the obstacles there. So for example, I use passiveinvesting.com as an example. For earlier on when we started, we were going after these C class, B minus type assets, doing a traditional value add. And so we were budgeting about $14,000 per unit in renovation costs and wanted to increase rents by about $300. And what we did was we renovated 2 of those units, brought those out to market, and we actually heard nothing. Brought the rent increase down from $300 to $250. We still heard nothing. We brought it down to $200. We still heard nothing. And we finally found that sweet spot of $170 rent increase. And so that really forced our hands to just go back to the drawing board. And we were able to cut our renovation costs and just prioritize the renovation costs from about $14,000 to $7,000 in reno costs. So we were still able to meet our margins, and then we actually exceeded our investors' expectations for that particular deal when we went full cycle on it. But that was just a huge learning lesson for us, just to make sure that we're more conservative in our underwriting, and then also to make sure that we're just more knowledgeable of the market and making before we actually dive in. Then you can even talk about some of their current asset statuses, like for now, for example, interest rates have gone up a lot. It's talking about some of those difficulties there. Are some of the distributions paused? Are some moved over to quarterly distributions? What are they doing to then move forward? So like for us, we did have to move quite a number of from monthly distributions over to quarterly distributions, and even pause some of the assets distributions, just because we wanted to make sure that we were well capitalized and we have enough reserves to weather any storm that's going to be coming, even with our interest rate cap. Cash flows are constricted by the interest rate being so high. Luckily, we bought our interest rate cap, but now we're just making sure that we just have enough reserves just to weather the storm, and then looking at our other options and exit strategies, whether that's a refinance or looking at possibly selling early based on market conditions. So getting a really good idea of just what they're doing now for their current assets, what have happened beforehand, and then talking through just in a way, I really look for stories from the operators that you're talking with, because how they respond is going to be very telling to what you can expect for the rest of the holding period, for however long you're invested with them in. Which then brings me to the next question, is just talking through communication. Like, what does communication look like when you're investing in one of these deals? Communication is actually one of Dan's biggest gripes when he was investing with just another general partner. So like Dan, he's invested in, I believe, like 80 plus different deals with 17 different operators. And so he's definitely had his fair share of pros and cons and what he's liked, what he doesn't like. And one of the main gripes that he's had was always communication. And this is also the reason why he's wanted a diverse amount, like around 3 general partners instead of 3 managing partners instead of just one. It's just because if one of them takes off to Costa Rica or Mexico, then you can at least reach out to 2 others, and you're not tied into just like, I have no idea what's happening. And so even within this question, they can say like, oh, we have monthly reporting, we have quarterly financials. But something that I would also take into account too, when you are looking into when you are communicating with them is how soon are they responding to your emails? How accessible are they? Can, even if you ask them a question and they're saying we'll get back to you, we're looking for this information, are you having to remind them to follow up on your original question, or are they very responsive? Because if you haven't invested with them yet, since they're pretty slow in responding to your requests, I mean, it's almost telling to say, how are they going to respond once you're invested and you're partnered up? So the minor details do matter when we're talking through communications past the monthly updates, past the quarterly financials. Just really start to see those behavioral patterns of, how soon they're responding, and then also how in depth these responses are. So what is that? That's number 3. The fourth question, I mean, this one's pretty simple, but just talking through the investment strategies, whether that's looking through asset classes, then also the markets that are invested in. I mean, there's a very diverse and broad range of different asset classes that you can invest in even like subclasses. So if you're looking at multifamily, you're either looking at suburban class A or B plus type assets, all the way down to opportunity zones. There's, C class assets where you're doing traditional value add. So I mean, that's going to be able to dictate, you'll be able to learn a little bit more about their philosophy, why they're in this certain asset class, and, what their business plan is looking to do. I mean, whether they're going to increase rents or on a yearly basis, doing some value adds for car washes. We're looking to improve revenues by, selling these memberships, and then decreasing expenses by negotiating with our chemical vendors. There's a lot I mean, this is a very loaded question, but it's always good to just get an idea of what type of deals that they're looking for. And then also what markets that they're invested in. And then, which also brings me to, I guess, the next question. This is question number 5, is who's actually operating and managing the deal. You'd want to know if it's a third-party property management company or if they're vertically integrated. And this also ties into the markets that they're invested in as well. So like if somebody says that they're vertically integrated and they have their own property management company, they're based out in South Carolina, but they're vertically, but their asset is over in like Texas or Denver or Colorado, you'd want to know how they're managing that deal. If they're not close enough to really know like what's actually going on in the market, or if they don't have a very strong, solid boots on the ground, it's you would just want to know that like their asset is actually being watched. And if it is a third-party property management company, it's, you want to make sure that they have that relationship with them, and making sure that they have like a really strong, I guess, cohesive synergy between the two. You can even look up reviews on how some of those current assets are. I think looking through Google reviews has been a great way to see, if the deals that they're managing are doing great. And then the only caveat I would say is for car washes, just because with car washes, they're just a lot more operationally intensive. And that's also why we stick to the Southeast first for passiveinvesting.com, just because, I mean, there's so many different granular details down to where water is being allocated on the car for the wash, whether that's on the tires or the actual body. And so because it's so operationally intensive, you'd want them to be closer to headquarters. You'd want them to be closer to headquarters, just because the team is out there already as it is. They want to be in a driving distance just to make sure that they can address any issues that come from there. Like if they were buying a car wash over in California next to me, since I'm the only person west of Colorado that's part of the team, I mean, I would even think that's not really a good idea, because, for somebody to bring somebody over and bring all of their systems all across the country, I mean, that would just be a challenge. I'm not going to say it's impossible, but that's a challenge. So knowing who the boots on the ground for all of these assets are is just a great question. Number 6, let's see, where am I at right now? Oh, talking about the fees and when they're taken. So the typical common fees that you're looking at when it comes to syndications, there's your acquisitions fee, asset management fee, and then disposition fee. Now they're typically percentages, but it's good to know what those percentages are taken from. And then also if there's any contingencies on when those fees are taken. So the acquisition fees, I mean, that's pretty straightforward. That's of the gross transaction amount. Some people might have it as a percentage of the purchase price. I guess some of the same thing. So the of the gross transaction amounts, that's what the acquisition fee is taken off the front. Then there's the asset management fee, which varies, but it's typically anywhere between 1.5% to 2%. And for us, it's taken out of the equity needed to raise, and that's taken annually. But the caveat to the asset management fee, though, is are they still going to be taking the fee even if they are not giving out distributions? So like if they are still giving out, if they, let's say they pause distributions, are they still taking the fee? And if they are still taking the fee, that's where the alignment of interest is a little bit gray, just because, I mean, they're not giving out distributions and then they're still getting paid. So I would personally want to see the investors' returns put first. And that's where the alignment of interest come in. So like, if we're not giving out distributions, we're not taking our fees. And the last one, the disposition fee is the other common one, is when you exit the deal. I like to see the disposition fee as performance-based. So like for us, I mean, depending on the asset class, it's only if you reach a certain percentage IRR. So like for multifamily and storage, it's typically a 13% IRR. For car washes, it's a 20% IRR. And if the disposition fee, let's say it's 2% or 3% of the gross transaction amount, that's only taken if you reach a 13% IRR or a 20% IRR. I want to see that just because, I mean, it also shows that the investors' returns are put first, which also brings me to my next question is, are your investor returns first? Oh, and are they capped? I know some operators out there, they have like a cap where you can only make like a certain percentage. So taking a look at just like what those waterfall equity splits look like, whether it's a 70-30 split and then, or a 20-80 or 60-40, just taking an idea of just what your potential returns could look like and that you're not capped. And then even just having that preferred return in there first, just making sure that your alignment of interests are there, that the operator is doing what they're actually saying they're going to be doing. And in order for them to get paid, LPs have to get paid first. Next question. I think that was number 7. Yeah, this is another pretty common one. Are the general partners investing alongside the limited partners? I would look for anywhere between 5 to 10% when they're investing as a limited partner, because this also informs the type of asset classes that they're in and also the markets that they're invested in. When they are investing alongside as an LP, it just means that they're putting their money where their mouth is. And I'm not talking about just taking their acquisition fee and then moving it over as an LP. I'm talking about truly taking, and yeah, you can even ask this up front too. This would be a great question as a follow-up question is, are you taking your acquisition fee and just reinvesting that into the deal as an LP? So that's a great question to ask. And then let's see what other, that was number 8. Boots on the ground. Let's see. I lost my train of thought here. We already talked about track record. I get those. That was a, oh, I guess as this is like a, oh, I have a lot more. I'm just trying to see which ones I want to go in order from. Next one, It's number 9. I'm losing my train of questioning because I'm like going through this. I have the list, but it's not numbered. How frequent are distributions when what does, how frequent are distributions? And then we kind of asked this a little bit earlier in question number 3, but what does communication look like? So distributions, I mean, asking them when they're going to be coming out with either it's monthly, whether it's quarterly, and then also taking a look at, if there's going to be any capital events that you can anticipate. But as a passive investor too, just note, especially now, that even if they do say monthly distributions or quarterly distributions, take a look at the underwriting and be ready just in case, let's say something unforeseen happens similar to what interest rates were rising, if they're going to pause distributions or if they're going to switch over to quarterly distributions. It's a tough conversation in the forefronts, and then talking through some of those tough questions in the beginning will definitely hedge some risk when you are talking to other operators. And then another question, how many investors have repeatedly invested with you? This one, I really like this question just because it shows that you have built that initial trust for people to actually reinvest with you. The only thing that I would say when it comes to this number is it could be skewed, especially if they're newer operators. Some of these deals, since the nature of these deals go for 5 years, they might not have any repeat investors because they haven't gone full cycle yet. Or maybe they do have repeat investors just because they had an early exit. And even if they did have an early exit, I think that's still great, and it still can dictate like why they want to repeatedly invest with them. But just something to keep in mind is, are these people actually building trust, and why are these people repeatedly investing with them? And actually, when I host these investor dinners across mostly in my side of the country, a lot of the reason why people are repeatedly investing with us is just because of the communication that we have. We're very accessible. We're always going to, if you shoot us a text, we'll respond. If you shoot us an email, we'll respond. If you call us, we'll respond. And so just figuring out why, and then they might tell you why people haven't repeatedly invested with them, but that's also some information that you should take a look at and I guess try and dig into. And then a bonus question that I really like to ask other general partners is, who are the general partners invested in as an LP? This is one of my favorite questions, just because, if you're just talking with us, you're most likely talking to other operators as well, but you'll start to hear the same names come up again, because there's a lot, like aside from Dan, and Dan, he's invested in 17 different operators at this point. There's other operators out there investing in other in other opportunities, and knowing who they're invested in and you're going to start to see just the same names come up. Knowing who they're invested in is also going to give you some insight on who the real players are in the game, because the challenge that you have is, especially when you're looking for people, let's say you're trying to get just passive investor references. Not saying that passive investor references that are current investors in their deal are bad, but most likely, they're going to be giving you just the people that really do like them, and you're still not going to get a full-on clear answer. And I guess that's also, that's somewhat similar too for asking who the general partners are also invested in. But it just gives you just another data points just to, I guess, like see who's just frequently coming up. But that's the list of questions that I have. Let's see, and we can open it up too. How do you determine if the operator has done due diligence, or say the developer, for example? Is the developer ethical? Do they have a good track record, etc.? That's from Paul. Yeah. So that's honestly a great question, because when it comes to due diligence, there would just have to be, honestly, I would just have an initial follow-up conversation with the team and really just break down the underwriting. That's the only way that I could, because I mean, you take a look at their track record, you take a look at their underwriting and actually walk them through, and they walk you through their different sets of assumptions, whether that's, you know, what rent growth is going to be looking like, or what the expense growth is really going to be looking like. At what point they're stabilizing the deal, and let's say how many units that they're actually, you know, stabilizing per month. I mean, you probably have to cross-reference a number of different resources, but just hopping on a call to just get a clearer idea with the operator to go through the underwriting, it's something that, I mean, we've done as well. So that's, and then also if they share their underwriting too, I think that's, and you can cross-reference it from there. So yeah, it'd have to be a little bit more guerrilla marketing type and more grassroots type of due diligence. But at the end of the day, I would even take it more as like an internal question too. Like if you are doing all of this due diligence, I don't think it just means that you haven't trusted them yet. So it may just take more time to build that relationship with them. All righty. If there's no other questions, I hope you have a great rest of your day. Take on the week, learn something new. I hope you learned something new from this conversation, and have a great week. See y'all.